Hello, and thanks for tuning in to Whitley Penn's Myth Busting podcast series. We're focused on busting common myths around accounting and taxes. My name is Katherine Kirk, and I'm a senior tax manager based in the Odessa office. Today with us, we have Breanna Oakley, who's a senior tax manager in Hobbs, and we are interviewing Bill Wilson. He's a director in Whitley Penn's Plano, Texas office. He comes to us from the IRS, so he's got some great insight he's going to share with us today. Bill, you're new to us, so introduce yourself.
Yeah, I'm Bill Wilson. I retired from the IRS after working there for 37 years. My entire career was at the IRS prior to coming to Whitley Penn. And I started there right out of college as a revenue agent. And I worked in headquarters several years in Washington, D.C. and ITNA, that's income tax and accounting. I worked in what they called back then the large case program. They've changed the name several times, but it's basically where they audit very large Fortune 500 type corporations. I worked in the Dallas regional office as a petroleum industry specialist, and I later finished out my career as a manager in the pass-through entities practice area where I focused on partnerships. So here at Whitley Penn, I primarily focus on tax controversy matters dealing with the IRS, handling audits, and I also work on partnership taxation issues and oil and gas.
That's great. And, knowing that you've been on the inside at the IRS, there's a lot of myths that bounce around about how things work and what they're doing on the other side. So I'm excited to get some answers to those. One of the first myths we hear a lot is if you file your return electronically, it has a greater chance of being audited. So what's the real story there?
That is absolutely false. And if anything, it might be the opposite. Filing electronically, at a minimum, reduces the chance for math error. Most electronic filing programs, I've been filing mine electronically for many years. And one nice thing about that is that I get all these pop-up alerts if something seems like it's out of whack, runs a variance analysis at the end, and gives me some little yellow flags, is your withholding correct? Because if I have any investments or something like that, I might tend to raise my withholding, and I get a question from the program, hey, is your withholding, is this number correct? So it really double checks certain items that appears to the program and possibly to the IRS that to be wrong. And at a minimum, it forces you to get the arithmetic correct, which is the most common reason that the IRS would contact somebody. Now, e-filing does give the IRS access to more data than they might otherwise have, and some people have wondered about that. I think the IRS in the past has had a policy that they're not going to use e-filing data to any greater extent to pick returns for audit than they would paper filed returns. And so I think that that's still the policy. But the bottom line is e-filing reduces the chances that your return will be rejected for math errors. And in the past, if it's rejected for math errors, well, maybe there's other stuff we should look at on that return. So at least you know that it gets there, that you get a notice that it's been accepted by the IRS, which basically means we got it and the math is right. And personally, that gives me a great deal of comfort, especially when I worked at the IRS where, doing your tax return wrong was considered a serious matter.
That's very helpful information. Another myth that we've heard is if you file an extension, it will increase the likelihood that you'll be selected for audit. Is that the case or is it not?
It is not the case. Well, this is an old myth that I believe comes about because somebody a long time ago did a study and it found that there was a correlation between returns filed on extension and returns that were audited. And that's one of these mathematical fallacies. Just because something occurs at the same rate, that there must be some relationship between the two. And that is just not true. It stands to reason that of all the tax returns filed, those that are filed on extension are going to be more complicated. They're going to be the ones where people are waiting on K-1s, waiting on information from third parties, maybe foreign information. These are more likely to be complicated returns. They're not typically W-2 wage earner type returns. And because simpler returns tend not to be filed on extension, and returns that have more tax at risk and have more material transactions nearly always are filed on extension, it's only natural that the latter category is going to have a higher audit rate. But it's a matter that because complicated returns tend to be put on extension, you may see a relationship there, but the relationship, the real causal factor is the complexity of the return and not the fact that it was put on extension. I can say based on my experience, and I was involved for a number of years in tax return selection, that I have no knowledge whatsoever that there's any program or any factor that looks at the filing of an extension as a determining factor in whether a return is selected for audit. So if you need an extension to get it right, file an extension. That's better than rushing it and not having what you need to do it correctly.
Well, speaking of not doing it correctly, there are times where for a wide range of reasons, you've got to amend your return. You missed something, you found an error after the fact. How does amending a return impact whether you're selected for audit or not?
Generally, it doesn't. I mean, the IRS is going to, an amended return is a tax return filing. So that means the tax return is going to be processed by the IRS twice. And, you know, it's going to go through the same process that it went through when it was initially filed. So if you're amending a return, particularly if you're asking for a significant amount of money back, it could raise, you know, an issue. But, you know, if you have proper documentation and it's all correct, then you shouldn't worry about it. So most amended returns, just like most tax returns in general, are accepted as filed. Of course, like anything else, materiality matters. And one area where filing an amended return does increase the likelihood of audit very, very significantly is what's known as a joint committee case or a joint committee claim. So if you claim a refund or credit on your federal tax return of more than $2 million or $5 million if you're a C corporation, the IRS is required by law to review that return, that amended return or claim for refund, and provide a report to the Joint Committee on Taxation. This is really kind of a slap on the IRS because I guess at one time, these very large refunds were going through, maybe some of them weren't correct. Whatever the reason is, Congress requires the IRS on refunds, and I'm not talking about a situation where you get a refund because you were over withheld or whatever. It's a situation where maybe an NOL is generated and carried back, or a big loss, something of that for that situation. And these actually, the IRS is required to either audit them or do a significant review and write a report to the Joint Committee. They're not all audited, but the IRS has to at least review them and send them over to the Joint Committee. But other than that, filing amended returns, just like filing any tax return, most of them go through, and I wouldn't be overly concerned as long as I can prove the numbers that I'm claiming.
Now, Bill, is that same thing true for superseded returns? I mean, that's a newer concept.
No, a superseded return is basically considered an original return. You know, a superseded return is one where you got the return on extension. And this is one reason I actually think filing extensions are a good thing, especially if you're a partnership. But if you have a return extension, you file a return and then you realize, oops, something wasn't right. You can actually file another return as a superseding return, and it's really considered the original filing. So that I would say that now that's going to be just like any other return. I mean, if there's something weird on it, might increase the audit rate. But again, the vast majority of all returns are accepted as filed.
You know, we get these pesky calls from scammers, and oftentimes they claim to be from the IRS. And there's the myth that if they're claiming to be from the IRS, it's a scam automatically. Is that true?
Not automatically, but I would be very wary. And here's why. And I've actually gotten those calls myself. They're actually amusing if you know anything about how the IRS works. These people claim that they're sending the police to your house and they're filing lawsuits against you. And people from the IRS don't even use that type of vocabulary. But here's why usually, if you get this is the first time you've heard from the IRS, it might be a scam, probably is a scam. The IRS initiates all of its first contacts with taxpayers through the mail, okay? If there's a problem with a tax return, if the IRS is owed money, they're generally going to send a letter, and more than one letter if they don't get a response to that letter before ever calling or visiting. The only time in my experience that the IRS is going to call you on the telephone is when you are already actively working with somebody from the IRS. So if you get notified in the mail that you're under audit, and you make contact with your agent, the agent may call you back. You get the letter, you call the agent, he's not there, he calls you back. That's not a scam. But if it's the first time that you've heard from the IRS and it's by telephone, it's probably a scam. Now, it's possible. So it's very rare to get a surprise call from the IRS. The only exceptions that I would know of is I have seen situations where people have moved numerous times and their mail has went who knows where, and they have gotten these notices from the IRS and they did not respond to them. After the IRS has sent you like 2 or 3 or 4 letters and they've gone unanswered, they're either going to call you or visit you. But the first contact is not going to be from by the telephone. If the IRS does call you and they say you owe money, then they're never going to ask you to pay with an iTunes card or anything like that, anything weird. They're going to ask you, they're not going to ask for a credit card. They're going to tell you you can send in a check payable to the United States Treasury, or they're going to direct you to the IRS website where you can make a payment there. They are not going to ask you to do an iTunes card or an eBay card or a gift card or anything like that. If that's the situation, then it is definitely a scam.
The IRS, when the typical taxpayer hears their name, they cringe, and our job is to kind of alleviate that fear. And one thing that typically comes up in my practice is the home office deduction, because they automatically associate it with audit. And is it true that claiming a home office deduction will trigger an audit?
Not anymore. Now, is it a deduction that can be abused? Yes. But when I started in the IRS, and I started in 1983, so, I'm kind of an old guy. But when I started in 1983, if you're claiming the home office deduction, that was probably very high probability that it was an abuse. Because let's face it, if you were working from home in 1983, you didn't have the internet, you might have a second line, but you didn't have the internet, you probably didn't have a decent computer. It's very difficult to work from home. Now it's routine. I mean, during the pandemic, everybody was working from home if they were able to, and if they had a professional job or whatnot. So a home office deduction is not as big of a red flag as it used to be. But even today, I know people who are entitled to claim it and they don't because they are worried that, it's a red flag. If you qualify for it, you should claim it. If you are a self-employed person working from home and it falls under the IRS rules, you're using that space strictly for work, meeting with customers on a regular basis, and the other criteria for a home office, there's no reason you should not claim it. It is not as unusual as it used to be back before the internet and before people were commonly working at home. It did sort of stick out like a sore thumb, but not anymore.
That's really, really good insight, and the history provided to kind of explain what drove that myth, and now, so is the IRS as heartless of an organization as people think or perceive?
It may seem that way at times, because in the end, IRS employees have to uphold the law that Congress passes, whether they agree with that law or not. If there are people who owe taxes, just like any other creditor, who haven't paid them, the job is to figure a way for them to pay those taxes. If you've got somebody who is withholding money from their employees' paychecks and not remitting that as deposits, it's a pretty serious matter. I mean, some people would call that embezzlement. I don't think we ever did at the IRS, but that was considered a serious enforcement priority. So they've got a job to do. Now, that organization is composed of human beings just like any other group. And all IRS employees have to comply with the tax law just like the general public. In fact, IRS employees are held to a higher standard in doing their own taxes and paying their own taxes than the general public, and can be severely disciplined, in some cases fired, for making even unintentional material errors on their tax returns. So they're subject to the same tax laws, and they're looked at very closely in terms of compliance. So most IRS employees have to comply, well, all of them have to comply with the same tax laws, but they also understand and experience through their work the bureaucratic frustrations taxpayers have to navigate. But there are some IRS employees who actually, their job is to help taxpayers navigate the bureaucracy, such as the Taxpayer Advocate Service. It actually goes to bat for taxpayers as their sole job responsibilities. So yeah, I don't think the IRS is a heartless organization. You might have some people whose interpersonal skills are better than others, like any large organization. But I don't think that, I wouldn't say that they're heartless. And in fact, because after the Restructuring Act, IRS employees now are evaluated on fair and equitable treatment of taxpayers. That's considered what's known as the retention standard. And I used to have to, on every employee, make a comment as to whether the retention standard for fair and equitable treatment was met for that employee. Basically, if I said no, they were going to be fired. So that's under the law. And so the concept has pretty much been drilled into IRS employees: treat taxpayers fairly, do your job, enforce the law, but be fair. And most have a strong commitment to doing that.
Well, when it comes to the tax law, there's some areas that are pretty much black and white, but there's a whole lot that we call gray. If you've got an issue and the IRS says you should or shouldn't have done X according to the tax law, is the IRS always right? Or are they sometimes in that gray and there's room for discussion?
Well, I think there's room for discussion in many cases. So always right? No. Sometimes right? Right many times? Yes. But if the IRS was always right, we wouldn't have a tax court. We wouldn't have cases going to court at all, many of which have even gone up to the Supreme Court. You wouldn't have an appeals organization that adjudicates disputes between taxpayers and the IRS. The tax law is complicated and it is often ambiguous. It seems to be getting worse because it seems like politically these days we have tax law that's rushed through at the last minute and not always thought through. So it's a complicated area. The statutes sometimes are ambiguous, and the facts as you apply to the law can be in dispute. So I wouldn't say that IRS agents are always right. And just like some tax folks on the outside, some agents are better trained than others. So they don't necessarily know the law better, and they tend to take a little more conservative view than maybe a taxpayer's representative might sometimes on the same set of facts. So yeah, I mean, they are agents of the government, so their job is to accurately and fairly protect the revenue base and apply the law the way the government's policy says that it's to be supplied. But that doesn't mean that they're going to try to squeeze money out of someone or inappropriately apply the law. So the IRS isn't always right. And if the IRS is auditing you and proposing substantial tax deficiencies and you have doubts as to whether or not it's correct, or you simply don't understand it, you should involve your tax professional in reviewing the report, dealing with the IRS, and making sure that you don't pay something you don't owe.
That's great to know. A lot of these myths have talked about, being audited by the IRS. I know for general public, that's a very scary thing. It's the worst thing in the world. It gives them a lot of anxiety. People are willing to pay more tax just to avoid an audit risk. If you are selected for audit, should you be scared? How big a deal is it? Can you talk about that a little bit?
Well, I wouldn't be scared unless I knew that I had committed tax fraud. Then I'd want my tax advisor involved, and we'd probably get an attorney involved. But if you believe that you've prepared a substantially correct tax return, you shouldn't be scared. You might think about being concerned because it's kind of like the first analogy that pumps into my head is not long ago I had a window broken out of my car while I was driving down the tollway, and I knew I had insurance. I knew I was going to get it fixed, but it was really inconvenient, right? I had time off work, this and that. So audits are inconvenient. Any type of audit is inconvenient. Financial audits are inconvenient. Internal audits are inconvenient. And IRS audits, even if you don't owe any tax, they're inconvenient too. It's part of the necessity and necessary evil to have a voluntary tax system. Now, the good news is most individual taxpayers and even some businesses are going to probably, if they're audited, which is a very low probability, but if they are, it'll probably be a correspondence audit. And correspondence audits typically aren't a big deal. You get a few questions, they send you a letter, and they want to see maybe some receipts or answer some questions and so forth. But if it does turn out to be a big deal, you do have appeal rights, and it's always a good idea, if anything material is involved, to involve a tax advisor. In-person audits are going to be a little more inconvenient. You have office audits and field audits. If you're a business, you might have a field audit, and typically the IRS agent is going to either come to your business or your home if that's where the records are, or to your CPA's office. Depending upon the size of your business and complexity, this can be a big deal. It's nothing to be scared of, but the major reason that I wouldn't want to be audited personally is the inconvenience and the time involved. And, if you hire someone to represent you, there's a cost there. So it's not something to be scared of. And if you're organized and well represented, it may get over with quickly and smoothly, but there's going to be an inconvenience factor there in terms of your time and trouble.
Now, if you were selected for an audit, if you ignore the letters that are coming in or drag your feet, will the IRS drop it? Will it make it go away? I mean, that's a myth that's kind of been circulating around a little.
Yeah, I've seen this several times. Some people actually try this. They think, well, I don't know what they're thinking. I mean, it could be they think, well, the IRS has so much on its plate. Maybe if I ignore this, they'll go away. Maybe they owe everybody, including the IRS. So they think, well, if I pretend it's not happening, maybe it's not happening. Maybe there's a different reality. Maybe I'll wake up from this nightmare. This is typically a very bad strategy. The IRS has, first of all, in terms of collections, the IRS has 10 years to collect tax that you owe, assessed tax. That's a long time. Now, as far as audit notices go, ignoring an audit letter or an inquiry about your tax return is always a big mistake. I think it's crazy to do that. And yes, once in a very great while, when the IRS gets overwhelmed, some things fall through the cracks. Usually they show up. And when they get caught up, you may get some sort of an assessment or a levy notice or some sort of enforcement action coming off the wall at you several years from now when everything's not fresh in your mind anymore. The records may be hard to get. So it's just a really bad idea to ignore any sort of notice from the IRS, because 99.99% of the time, it is not going to make them go away. It's only going to compound the problem and create more problems. So meet the problem head on. If you need help, contact a CPA with experience dealing with the IRS. Your life will be a lot easier that way.
Now, staying on the topic of audits in the IRS, do IRS agents get bonuses based on the tax they assess or collect? I mean, are they incentivized to collect on behalf of the agency?
No, they are not. And that is a little bit of a myth. And in fact, it is against the law to do that. I mentioned briefly about the fair and equitable treatment standard. Well, there's also a standard under Section 1204 of the IRS Restructuring Act. You may remember, if you're around then, and there have been several of these, there have been several taxpayer bill of rights and so forth, but there was, many years ago, there was, way before my time, the IRS supposedly looked at the tax that its employees assessed and collected in making determinations as to whether or not their employees were doing a good job. When I came in, that was prohibited, but there was still sort of an undercurrent that, well, if you're really good at your job, you're going to go out and audit and find all kinds of things wrong, right? I don't think that was done with any evil intent. I think that the belief was that if we select returns for audit, they probably need to be audited. And if you're assigned one, and they didn't always tell you why it was selected, they said this return has higher risk of understatement of tax, you're supposed to figure that out as an auditor. And they were sort of thinking that, well, if you're a good auditor, you'll figure it out and come back with a lot of tax. Well, Congress, even though that was not really the right policy, it wasn't the policy at all, it was just sort of a feeling some people had. Congress outlawed that. Now it is expressly forbidden to evaluate an IRS employee based upon what they call enforcement statistics, essentially the amount of tax you assess or collect. And that's a fireable offense, and managers have to certify on a regular basis that they do not do that. Now, how can it happen? I mean, wouldn't you know that you're doing that? Well, you might write somebody a positive evaluation based upon an issue that they raised. And say you raised a $2 million issue, that was a superior audit technique. Well, the fact that you mentioned that it was a $2 million issue suggests that you might be evaluating them based on the tax that they're assessing. That's against the law. And so every IRS manager must certify he does not do that. It's strictly against policy, and it's considered a serious offense if you do it.
We are so lucky to get your insight on the inner works of the agency, especially when it comes to audit selection and these common myths. You know, you were there. You retired from there. You were there for a very long time and seen so many changes through that agency. And we're really lucky to get your insight on that. One of the last myths that have been circulating for, I would say, many years. I get phone calls on this kind of every year, a handful. And the myth is, hey, do I only need to keep my records for 3 years? And what's your take on that?
My take on this is that it depends upon the records. So if you, typically 3 years is right. And the 3 years comes from the fact that the IRS has 3 years from the date of the return filing to do an examination, okay? So you want to keep your records at least 3 years. But there are some records that you might want to keep longer than that. Now, the IRS has 6 years if there's a substantial understatement of tax, and they have an unlimited amount of time if you don't file a tax return or if there's fraud involved. But in most cases, we're talking, they're not going to audit you outside of 3 years. They don't like to pick up short statute returns. That's considered, if you pick up a return and allow the statute of limitations to expire, that's a bad thing. So 3 years in most cases is enough. If you have other records, such as basis records, you've got depreciable assets, you bought stock, you've inherited assets that you might sell or have sold. You would need to keep those records longer, as long as they're relevant in doing your tax return. So if you got depreciable property, as long as you're depreciating it, that might be way beyond 3 years. You need to be able to prove the basis of that property. Personally, what I do is I keep my records at least 6 years, and I keep my basis records on investments indefinitely until I dispose of the investments. And the way I do it, I file electronically, and I scan all my records in that have to do with my tax return, and I store them in I use Microsoft Cloud, and then there's a bunch of different things. Dropbox is another, but I use an online document storage. That way it's always backed up. I'm not going to lose it. And this is pretty cheap storage these days, so it's a good way to hang on to your records. But 3 years is enough for most folks. But if you've got basis records, you're going to need to keep them as long as you have the asset that is in question.
Now, Bill, I kind of want to elaborate on the stock basis in specific. Is it safe for taxpayers to rely on the brokerage account to keep track of that cost basis on their behalf?
I think that it is. That's the information that the IRS is going to get. So unless you know that it's wrong, and if you think it's wrong, you should notify the broker. I typically think that that's sufficient, but I keep the records anyway, just in case there's any question as to whether or not the broker basis records are correct.
Well, thank you. It's been a pleasure.
Thanks so much.
Thank you.